Hey, wealth builders, welcome. Comment the country you're tuning in from. Let's see how global our squad really is. Imagine the scenario. Every month, without any extra work, a sum of money is deposited directly into your bank account. No more hustling for clients, no need to chase sales, or handle tenants who fail to pay rent. You do absolutely nothing, and yet the money keeps flowing into your account every month. While this may seem like a dream to many, it's a very achievable goal that's entirely possible with a smart investment strategy. What if I told you that you could achieve this financial freedom simply by investing in companies that pay monthly dividends? In this video, I'm about to unveil a strategy that has been a game changer for countless investors. I will share the secret that can transform you into one of those investors who can live off passive income generated through monthly dividend payouts without needing to trade time for money. This is more than just a promise. It's a proven method accessible to anyone willing to learn and take action. I'll be revealing 3 specific stocks from companies listed on the stock exchange that pay monthly dividends to their shareholders. These companies aren't startups trying to prove themselves in a tough market. No, these are giants in their industries, companies with solid foundations that have been around for decades. Some of them have been paying monthly dividends for over 20 years, maintaining their consistency through multiple recessions, crises, and global economic downturns. Before we dive deeper, let me take a moment to remind you, if you haven't subscribed to the channel yet, this is your chance. Hit that subscribe button and turn on the notification bell so you never miss out on more strategies like this. You're in the right place if you want to see your money working for you, instead of it just sitting in your bank account doing nothing. Let's get started. So why is a regular monthly income so appealing to investors? What makes monthly dividends so attractive? When a company earns profits, it can either reinvest those profits into the company's growth or distribute them to shareholders in the form of dividends. Many companies, like Apple and Coca-Cola, distribute dividends on a quarterly or annual basis. While this is the most common method, there's another model that's gaining traction among investors. That's right, companies that pay monthly dividends. So, why should this be a priority for you as an investor? The answer is simple: reliability and consistency. When you receive dividends every month, it provides a sense of financial security. You are assured of a steady stream of income that arrives regularly and not just once or twice a year. Monthly dividends offer stability and ensure that you can rely on a continuous flow of income without worrying about cash flow gaps between payments. Let's break this down with an example. Suppose you invest $1,200 in a company with a 5% annual dividend yield. If that company only pays out once a year, you would receive $60 in one lump sum. If the company pays quarterly, you would receive $15 every 3 months. But if the company pays monthly, you would receive $5 each month, bringing the same total of $60 by year end. It's not more money, just a more frequent payout that allows you to reinvest your dividends more regularly. The power of regularity can have 2 profound advantages. The first is motivational. Seeing your money come in every month is rewarding. It encourages you to stay engaged with your investments, and it makes the whole process of building wealth more tangible. The second advantage is compounding. If you receive monthly dividends, you can reinvest them right away, instead of waiting for a large payout at the end of the year. Reinvesting regularly accelerates the compounding effect, which can exponentially grow your portfolio over time. But be aware that not all companies are created equal, and simply investing in a high-yielding dividend stock does not guarantee a successful outcome. You need to choose companies that not only pay consistent dividends, but are also financially stable enough to continue paying these dividends well into the future. You want companies that can weather economic storms and still provide steady payouts. There are 4 key criteria to look for when selecting companies for monthly dividend payments. Dividend history. Has a company been paying dividends consistently for years, even through difficult economic conditions? A company that has paid dividends during multiple market crises, such as the 2008 financial crash or the COVID-19 pandemic, is a much safer bet. A long track record shows that the company has a solid financial foundation. Payout ratio. This ratio tells you what percentage of the company's profits are paid out as dividends. A higher payout ratio can signal that the company is using a large portion of its earnings to pay dividends, which may leave it vulnerable during tough times. A payout ratio between 40% and 70% is typically considered ideal because it ensures that the company can cover its expenses, reinvest in its business, and still pay dividends to its shareholders. Stability and growth of dividends. Is a company consistent with its dividend payouts? Do the dividends fluctuate from year to year? It's important to choose companies that not only pay stable dividends, but that increase them over time. A reliable company will either maintain or increase its dividend payments annually, showing that it can manage its finances well even during economic downturns. Sector. The industry in which the company operates matters. Some industries are more resilient than others. For example, industries like commercial real estate, healthcare, and consumer goods tend to be more stable and less susceptible to economic cycles. A company in a volatile industry might offer a higher yield, but also carries a greater risk. Choosing companies from recession-proof sectors will give you a more secure and predictable source of passive income. Now that you understand the essential criteria to look for in monthly dividend-paying stocks, let's explore 3 companies that meet these criteria and have demonstrated a proven track record of consistent, reliable payments. These companies are not only financially strong, but they also provide investors with a steady flow of income that can be reinvested or used to build long-term wealth. 1. Wealthy Properties, Commercial Real Estate Investing. The first company I'll introduce is Wealthy Properties, a leader in the commercial real estate sector. Wealthy Properties owns a portfolio of over 20,000 properties across the United States, including office buildings, shopping centers, and industrial warehouses. The sheer scale of their portfolio allows them to generate consistent rental income, which is then distributed to shareholders in the form of monthly dividends. This is one of the biggest advantages of investing in real estate through a real estate investment trust REIT, like Wealthy Properties. Rather than deal with the hassle of managing individual properties, investors can participate in the cash flow generated by thousands of rental units spread across various regions, thus minimizing risk and increasing stability. Wealthy Properties has been paying monthly dividends without interruption since its inception, and its current annual dividend yield is 5.2%. What sets Wealthy Properties apart from other REITs is its history of growing dividends. Over the years, the company has not only maintained its payouts, but has also consistently increased them, even through turbulent times like the 2008 financial crisis and the global pandemic. This track record is a strong indicator of the company's financial resilience and its ability to adapt to market conditions while continuing to reward its shareholders. The company's payout ratio sits at 75%, which means it distributes a large portion of its profits to shareholders. While a higher payout ratio can sometimes be a red flag for other types of companies, it is actually a requirement for REITs like Wealthy Properties, as they are mandated by law to pay out at least 90% of their taxable income in dividends to avoid taxation. This is one of the reasons why REITs can offer such attractive dividend yields compared to other stocks. Wealthy Properties' model of leasing its properties to long-term tenants like Target, FedEx, and Walmart adds another layer of security. These companies have strong financials, providing steady rental payments, even during economic slowdowns. Key points of Wealthy Properties. Dividend yield, 5.2% annually, paid monthly. Payout ratio, 75%, ideal for REIT. Resilience, continue to increase dividends during major economic downturns. Solid portfolio, over 20,000 properties in the U.S., leased to top-tier tenants. 2. Eco Warehouses, leveraging e-commerce growth. The second stock on our list is Eco Warehouses, a company that specializes in the ownership and management of logistics warehouses. In today's fast-paced world, e-commerce has experienced explosive growth, and the demand for storage facilities and fulfillment centers is higher than ever. Eco Warehouses owns and operates over 300 warehouse facilities across the United States, strategically located near major logistics hubs to serve e-commerce giants like Amazon, Walmart, and eBay. With an annual dividend yield of 4.6%, Eco Warehouses offers a compelling option for those looking to tap into the growing demand for logistics and storage space. The company has a solid history of paying monthly dividends for over a decade, providing consistent income to investors regardless of market fluctuations. This consistency is a testament to the strength of their business model, which focuses on stable, long-term leases with high-credit tenants. The revenue generated from these leases is distributed to shareholders through monthly dividends. The payout ratio for eco-warehouses is 68%, which is within the optimal range for a REIT. This allows the company to maintain a healthy balance between rewarding shareholders and reinvesting in its expanding portfolio of warehouses. As the rise of e-commerce continues, the demand for storage and distribution centers will likely remain strong, ensuring a steady stream of income for investors in eco-warehouses. Key points of eco-warehouses: dividend yield, 4.6% annually, paid monthly. Payout ratio, 68%, allowing for growth and sustainability. E-commerce-driven growth, capitalizing on the growth of online shopping and logistics. Strong tenant base, long-term leases with high-credit tenants, such as Amazon and Walmart. 3. Prime capital partners, financing small and medium businesses. The third stock I'll discuss is Prime Capital Partners, a unique company that provides capital to small and medium-sized businesses, SMBs. Prime Capital Partners specializes in offering financing to businesses that are underserved by traditional banks, providing either equity investments or loans. While investing in companies that finance businesses can be riskier than real estate or storage, Prime Capital Partners has proven itself by carefully vetting the businesses it finances, ensuring that only the most promising companies receive funding. Prime Capital Partners offers an impressive 6% annual dividend yield, which makes it an attractive option for those seeking higher returns. The company has paid stable monthly dividends for over 15 years, a remarkable feat in the high-risk world of business financing. The company's strong track record is supported by its low default rate on loans, as it carefully selects businesses that have a high likelihood of success. With a payout ratio of 85%, Prime Capital Partners distributes a large portion of its profits to shareholders, but it still maintains ample capital to continue its lending operations. The company also occasionally pays special dividends once or twice a year, adding a bonus for investors who are looking for higher yields. This makes Prime Capital Partners a standout option for those looking for income-generating opportunities in the alternative investment space. Key points of Prime Capital Partners: dividend yield, 6% annually, paid monthly. Payout ratio, 85%, with the ability to make occasional special dividend payments. Business financing, providing capital to small and medium-sized enterprises, SMEs. Low default rate. Rigorous loan selection ensures stability for investors. While investing in stocks that pay monthly dividends offers a fantastic way to generate consistent income, one of the most powerful investment strategies is diversification. The idea behind diversification is simple. Instead of putting all your eggs in one basket, you spread your investments across different stocks, sectors, and dividend schedules. This approach not only helps you reduce risk, but also maximizes the chances of having a continuous income stream, no matter what happens in the market. Diversification is particularly useful when you want to receive dividends every month, but you don't want to rely on a single company to do so. For example, while some companies pay dividends quarterly, others pay annually. By combining a mix of stocks that pay at different times, you can ensure a steady flow of income month after month. This is a key strategy for building long-term wealth and maintaining financial stability. One of the easiest ways to implement diversification is by investing in companies that pay quarterly dividends but at different times of the year. By selecting companies from various sectors that have staggered dividend schedules, you create a monthly income stream without needing to rely on just one stock or sector for payouts. Example of how to diversify using quarterly dividend-paying stocks. Let's say you want to create a diversified portfolio of dividend-paying stocks, and you decide to focus on 3 large, well-established companies. These companies pay quarterly dividends but at different times of the year, so you can create a strategy that ensures you receive payments every month. Coca-Cola. This globally recognized beverage company pays dividends in January, April, July, and October. Johnson & Johnson. A leader in healthcare, Johnson & Johnson pays dividends in February, May, August, and November. PepsiCo. Another iconic brand. PepsiCo pays dividends in March, June, September, and December. By investing in these 3 companies, you are ensuring that you'll receive dividends every month. It works like this. In January, you'll receive a dividend from Coca-Cola. In February, you'll receive a dividend from Johnson & Johnson. In March, you'll receive a dividend from PepsiCo. In April, another dividend will come in from Coca-Cola. In May, you'll get a dividend from Johnson & Johnson, and so on. This strategy ensures that your investment is working for you continuously, with payouts from different sectors. Coca-Cola provides stability and growth potential in the beverage sector, Johnson & Johnson offers reliability and growth in healthcare, and PepsiCo brings consistent performance in the consumer goods sector. The beauty of this diversification strategy is that you don't need to worry about having large gaps between dividend payouts. The companies involved are well established, meaning the risk of a company cutting its dividend payments is low, and by diversifying across multiple sectors, you are reducing the risk of being exposed to the volatility of one single industry. Why diversifying across sectors matters. Let's take a closer look at the importance of sector diversification in your dividend strategy. Different sectors of the economy can be affected by various factors, and some may perform better during different economic conditions. By diversifying across multiple sectors, you ensure that your investments are more resilient no matter what happens in the market. Consumer staples. Companies like Coca-Cola and PepsiCo fall under this category. They produce goods that people buy no matter the economic climate, such as food, beverages, and household items. These companies tend to perform well during both boom and recession periods, making them a solid choice for consistent dividends. Healthcare. Johnson & Johnson represents the healthcare sector, which is another sector that remains resilient during economic downturns. Healthcare is essential, and people continue to spend on pharmaceuticals, medical devices, and healthcare services regardless of economic conditions. Companies in this sector are known for paying stable and growing dividends, which makes them a reliable source of passive income. Real estate and logistics. While not part of the current example, companies that specialize in commercial real estate logistics or storage space, like wealthy properties or eco-warehouses, are other examples of sectors that provide steady dividends. The real estate sector has a relatively low correlation with the stock market and can provide income even in times of market volatility. By having investments in consumer goods, healthcare, and real estate, you are creating a well-rounded portfolio that benefits from different economic cycles. If the consumer goods sector underperforms during a recession, the healthcare sector may remain strong and vice versa. This sectoral diversification helps to ensure that you have a constant stream of income, even if one particular industry faces difficulties. The power of compounding and reinvestment. Another important factor in building long-term wealth through dividends is the power of compounding. Reinvesting your dividends, especially when you receive monthly payouts, allows you to increase your returns over time. Instead of spending the dividends you receive, consider reinvesting them into more shares of the same or other dividend-paying stocks. This helps to accelerate the growth of your portfolio, as you're not just earning on your initial investment, but also on the dividends you've already received. When you receive dividends every month, you have the opportunity to reinvest regularly. Reinvesting your dividends monthly allows you to take advantage of compound interest, where you earn returns not only on your initial capital, but also on the reinvested dividends. This can create a snowball effect over time, where your portfolio grows at an increasing rate. For example, imagine you start with a $10,000 investment in dividend-paying stocks. You receive $500 per month in dividends, 5% annual yield. By reinvesting that $500 each month, you don't just add $500 to your account. You earn dividends on that $500 as well, creating more income for the next month. Over time, this compounding effect can significantly increase your wealth, especially if you keep reinvesting the dividends instead of spending them. Using exchange-traded funds, ETFs, for simplified diversification. If you're new to investing, or if you don't want to spend too much time selecting individual stocks, exchange-traded funds, ETFs, can be a great way to diversify automatically. ETFs are funds that pool money from multiple investors to buy a basket of stocks. Many ETFs focus specifically on dividend-paying stocks, so by investing in one, you can gain exposure to multiple dividend-paying companies without having to select each one yourself. For example, there are high-dividend ETFs that invest in companies that pay monthly dividends. These ETFs may focus on industries such as real estate, consumer goods, healthcare, or energy. By investing in an ETF, you're spreading your investment across many stocks, which reduces the risk of relying too heavily on any one company. Additionally, ETFs often pay monthly dividends themselves, which means you can receive consistent payouts while diversifying across sectors and industries. Advantages of using ETFs: diversification, exposure to multiple companies, reducing the risk associated with individual stocks. Convenience: ETFs are easy to trade, just like individual stocks. Monthly dividends: many dividend-focused ETFs pay monthly dividends, ensuring a consistent income stream. Lower costs: ETFs usually have lower fees compared to actively managed mutual funds, making them a cost-effective way to invest. By investing in ETFs, you can take advantage of the expertise of professional fund managers who select the dividend-paying stocks for you. This makes ETFs an excellent option for those who want to invest passively while still receiving monthly dividends. Building a long-term dividend portfolio. The key to building long-term wealth through dividends is not just about finding high-yielding stocks. It's about developing a consistent strategy that allows you to reinvest your earnings and grow your portfolio over time. As you accumulate more shares, your monthly dividend payments will increase, creating a self-sustaining cycle. Start small, but think big. Begin by selecting reliable dividend-paying stocks or ETFs, and use their monthly payouts to build wealth over time. As your portfolio grows, your income will also grow, and you'll eventually have a diversified portfolio that generates a substantial passive income. This is the power of dividend investing: slow, steady, and consistent wealth building.